begin with it?
Yes, roll call, Dawn.
Sure. Jerry Abrahams.
Here.
Alexandra Dahm. Philip DeFranzo.
Here.
Timothy Hodges. Catherine McKinnon. Commissioner Perez. Franklin Perry.
Present.
Sarah Sanders.
Here. Okay, I guess our first item of business is financial reports. Allison Murphy.
Good
Sorry.
morning, all.
I think I missed the roll call. This is Alexandra Dahm. I apologize.
So before you are the May financial reports. On the revenue side, mortgage loan and investment interest revenue are coming in 2.7 million below budget for the first 5 months of the year and 5 million lower than prior year. Program assets continue to be the driver on that, coupled with the fact that over the last 2 years, higher rate loans were being paid off and replaced with lower rate loans. On the expense side, bond interest expense is below budget by 5.9 million through May 31st and 6.7 million lower than prior year. The authority's outstanding bonds as of May 31st are 511 million lower than the same time last year, which accounts for pretty much the largest part of our year-over-year variance. Administrative expenses are coming in 3.5 million under budget and 241,000 higher than prior year. When you exclude salaries and benefits or 11.2 million, the current year expenses are 646,000 lower than prior year's expenses. Salaries and benefits are a large portion of that current year budget variance. CHFA is approved for 148 positions. And as of the end of May, we had 132 FTEs. So we're actively recruiting for 11 positions right now, 3 of which are durational pertaining to the My Home CT program, and 8 are regular full-time employees. You're going to see a link to our open positions in the headline news email that you folks get. Typically, it'll be the first one that goes out of the week. Usually that's Monday or Tuesday-ish. And lastly, the change in net position is above target by 7.6 million through May. Are there any questions?
I have Allison, one question. Is the pace of asset depletion steady? Or
It's
is it-
actually slowing down.
It is slowing. Okay.
Yes, our prepayments made the first 5 months of this year were 152 million, and that's actually 73 million less than the same 5 months of last year.
And so just from on this, so the prepayment activity is slowing. And then as far as we're still, is the pace on new single family origination all staying about the same or slowing or getting quicker? Or?
John, do you think you could chime in on those numbers?
Sure, actually, Jared, I'll cover that in just a minute.
Okay.
But I would say
I'll wait. We can wait for it.
yeah, steady to improving.
Mhm.
Okay, great. Thank you.
Any more questions for Allison? We'll move on to John Chilson for the delinquency and forbearance report. And one of the questions I had, I just checked on your website, the residential rate that we're offering is 5.5%. And I'm just, one of the things, if you could just cover, how frequently do we change that rate? I know I'd be interested in knowing that, and of course that's quite a bit higher. So, okay, over to you, John. Thank you.
All righty. Well, I can address the rate directly, or perhaps Hasim, you'd like to address the rate. I can say that we do adjust the rate daily.
Daily, okay.
And it's based on a number of metrics that we look at and in determining what the rate will be. Okay, for the month of May, the authority purchased 103 loans totaling $23.5 million, of which 85 loans totaling $19.3 million were securitized, or 82.5% of May's production. Remaining 18 loans totaling $4.2 million were whole loans. The average loan size was $228,000. For the month of May, the month-end mortgage-backed security balance was $2.1 billion, which is a decrease of only $1.7 million from the prior month, where previously we were seeing decreases in the $8 to $10 million monthly range. The whole loan portfolio declined by 87 loans, or $10 million, with an ending portfolio balance at the end of April at $1.2 billion. And we are seeing more payoffs on our whole loan portfolio than we are in our mortgage-backed security portfolio, simply because our whole loan portfolio is older and has a greater number of, or a greater percentage of higher rate loans. The overall delinquency rate for the month of April was 12 basis points lower than the prior month, and ending at the 2.3%. And the carrying balance for loans in foreclosure year over year decreased by $6.4 million to $29.4 million, while the number of loans in foreclosure decreased by 36 year over year. For the month of May, the authority also funded 93 down payment assistance loans totaling $1.3 million. The average loan size was $14,400. Approximately 90% of the May borrowers took advantage of the down payment assistance program. With regard to loans and forbearance, as of the end of April, we only had 95 whole loan borrowers in forbearance, involving $70,000 of monthly P&I payments on $11 million of principal balance, or slightly less than 1% of the whole loan portfolio. And given the fact that the loans in forbearance are less than 1% of the overall portfolio, this will be the last month that we'll highlight the status of forbearances in my monthly report. The multifamily portfolio, we didn't have any new closings for the month of May. The portfolio decreased by 2 loans to 554 loans, totaling $1.3 billion. The permanent loan delinquencies decreased by 2 loans to a total of 6. There were no construction loans in delinquency, and the overall delinquency rate for the multifamily portfolio was only 0.6%. Any questions?
I have a question not directly related to your report. Maybe it'll be addressed in the full board meeting, but the new program we have for up to $50,000 of down payment assistance, very impressive, the 20 million. But I calculate if everybody gets 1,000, that's only 400 loans. But are you getting slammed with applications for that? Maybe it's more for Hazim. It seems like it's such an attractive program, and just wondering, it's open now, I believe. I'm just wondering if you're getting slammed.
Well, the slam, it depends to how you define slam. I would say that we did get a lot of coverage and interest from folks trying to gather as much information as possible in terms of how they would be able to qualify. We are, fielding those questions, as best as we could, but we have been seeing an uptick in reservations for borrowers that do qualify for the amount. So the way the program works is a borrower is eligible to receive up to 50, but it's also determined based on where the property is located.
Right. I remember that.
So it might be a little early days to make any sort of judgment call about how many borrowers. What we're seeing so far, just based on very small percentage of applications we've received to date, is that about 30% are going to potentially receive the higher amounts, and 70 are going to be at 25 or less. So I don't think we're going to get 100% at 50,000. But it's still early days, so it's hard for me to draw any conclusions from that or extrapolate. But it's only been open a couple of weeks, and I think lenders are the ones who are participating in the program are trying to get up to speed and look at eligibility, and it's a complicated program. There's a lot of, there's a lot of pieces of the puzzle that have to be, made to fit to make it work. So, but we're hopeful. I think we're seeing a lot of interest, and we're hoping it will result in, significant number of home buyers getting homes in an otherwise very difficult market. So
And when the 20 million runs out, is there ability to go back and get more?
there's always the ability to go back and ask for more. But I don't know the answer to that. I think the commissioner has indicated, but potentially yes, but I guess we'll have to see. Yeah.
Okay. Well, I thought the rollout was good. I heard about it in several different venues, and it really seemed to get a lot of attention. So
Yeah, I see it. When do we expect the 20 million to run out? Or is it too soon to tell because we haven't, the originators haven't geared up yet?
I mean, it's hard to say. I would say probably 4 or 5 months
Okay.
based on what we're seeing so far.
any other questions for John? We'll move on to the internal audit report with Joyce Kempe.
Good morning. I'd like to provide you with a mid-year update on the 2022 audit plan that was presented to you in January. The first memo in your package summarizes the audit activity for the first half of the year, followed by the updated internal audit plan. As you may recall, the plan just basically has 3 component parts. We focus on CHFA audits, which is a subset of the larger audit portfolio that we defined at the beginning of the year. The second part is a cyclical compliance review of single-family loan servicers from our servicer portfolio, as well as any consulting activities which have been requested by management. Starting with the CHFA audits, the focus of 2022 has been to work on various aspects, higher risk aspects of the multifamily business. To that end, during the period, we completed a follow-up review of the monitoring of multifamily loans and loan payment processing. The original audit reviewed controls over the billing, the collection, the accounting of multifamily loan payments, as well as the monitoring of delinquent assets. Results of our review have concluded that the majority of the audit recommendations from the original report have been implemented. We now have in process a full audit of the multifamily escrow processing. Turning to single-family loan servicers. Now, a servicer review is a limited scope review of single-family loan servicers processing and collection functions. The scope typically entails a review of compliance with key contract terms and insurer guidelines. During the period, we completed 2 desk reviews, Idaho Housing and Finance Association and Capital for Change. Review letters were issued and servicers management responses were reviewed and accepted. Idaho Housing and Finance Association services about 2,800 single-family second mortgages or DAP loans for the authority. It's an approximate loan balance of $22 million, and it's a little less than a quarter of the authority's single-family second mortgage portfolio. Capital for Change, and with Capital for Change, we focus on the first mortgages. There's approximately 230 single-family first mortgage loans. It's about $7 million of the loan balance, and that represents about 1% of the authority's single-family first mortgage portfolio. We do have 2 additional servicers in process, nearing completion, and we anticipate review letters going out for response this week. Those servicers are Amerinet and KeyBank National Association. So we have 1 additional servicer on the plan, which is M&T Bank. As you know, they recently acquired one of the servicers that serviced for us, which was People's Bank. So we do not anticipate completing this review in 2022, as it is still pending integration of servicer organizations. Turning now to consulting activities. During the period, we performed a number of consulting activities, including analyzing project expenses and supporting documentation for several HTCC awards at the request of the legal department. We additionally participated on the CHFA technology strategic planning process as a member of the stakeholder group. And that was in addition to the 2022 audit plan. So with that, I'd be happy to answer any questions you have on the updated plan.
I have a question.
Yes.
I just want to make sure I got the program right. That the multi-family program is the one that we have to issue with employee, right?
Commissioner, can you repeat the question, please?
I just want to make sure I got the
Yeah.
program right.
Yeah.
About 2 years ago, because we did it in person, so it was right prior to COVID. We had an issue with one of our programs with an employee sending people to the wrong address and not getting paid by us and the developer or the construction company. Is that the multi-family?
No, that's the HTCC.
Okay, so have you done
Program.
anything follow up in that one?
That is the consulting activity, which I just
You keep on breaking up.
described. So we've been working with legal documents.
I'm sorry. You keep on breaking up.
Oh, I'm sorry.
And I'm in the office, so I'm connected directly, so it's not from my end.
Okay. So yes, during the quarter, we did review project expenses and documentation for those awards under the direction of the legal department, working in conjunction with legal.
What about the recommendations that were made? Have they been implemented? Are there any pending?
That was that review was completed at the end of last year. And there were definitely recommendations made to continue to improve the controls. And we monitor those quarterly. So yes, there are still some outstanding, but it's more for additional continuous refinement and improvement to the controls that were put in place.
Are there any that you think are critical that need to be done sooner than later, or you feel comfortable that the progress is adequate?
The progress is moving forward.
That's not my question. My question is, has the progress been adequate? Meaning if there's a particular weakness that you feel is strong, are they addressing that weakness?
Yes, I believe they are.
Okay, thank you then. I'm all set.
Okay.
Any other questions for Joyce? I have another random question going back to how we set our lending rate of 5.5%. And, I know the Fed's going to meet again soon. And is it, would you say it's primarily tied to the 10-year treasury? What would you say is the biggest driver of setting our rate?
It's somewhat tied to the 10-year. But it's not it does not have a direct correlation to the 10-year. So it's also driven by market interest. So for example, the Fed, in addition to raising the interest rate, they are also going to unload on the securities that they have purchased, during COVID. So that in itself, by unloading those securities, it would impact the interest rate because now you're flooding the market with securities.
And I should probably know this better, but is our rate more tied to the market, or is it tied to our cost of funding when we issue our bonds? And to the extent it is tied to our most recent, funding source that might be lagging, can we expect other increases as our funding cost increases? If you know what I'm saying.
Yep. No, I know what you're saying. So what happened when interest rate was low, where we were experiencing rate compression, we were having a bit more difficulty differentiating our product with what's being offered out there. But with the rise of interest rate, we do not need, or we have more flexibility, and we do not need to ramp up our interest rate as fast as the market. If you go and look at the current indication for a prime borrower for a 30-year mortgage with a 20% down, some lenders are quoting in excess of 6%, and we are below 6.
But just to complete my question, is part of our advantage because of our cost of funding is somewhat lagging, because rates are moving up so quickly. And can we expect that we will be catching up as our funding cost increases?
Right. So let me just add by saying that because of our cost of funding, we can offer a much better rate than what a customer can get from a private lender.
Mhm. But that's lagging because rates are moving up so quickly.
It is lagging because right now what's happening, and we just entered and sold some bonds this past Monday. What's happening right now is you have investors looking for direction, and they're trying to protect their investment against further rise in the interest rate. So what would happen is those same investors would demand a higher rate for that hedge protection. In our situation, what we have done, and we have presented to committee, we have structured our bonds based on the performance of our loans, i.e. the average life of such loan. So depending to the structure that we pursue and the amount of risk that we're willing to take, such as the use of variable rate debt, we are able to offer that lower below market interest rate.
Okay, Commissioner Perez has a question.
Yes, I mean, Hassim touched on what I was going to ask him to clarify. I was going to ask you the same question, but a little different, which is regardless what our cost is, regardless how you calculate it, historically, we're always going to be below the market.
Yes, that's correct.
So that's what makes us attractive, because not only do we deal with the more difficult lending situations, whether it's credit, whether it's down payment, but historically, we're always going to be, anywhere from a quarter point or better than the market.
That's correct.
So yes, rates are going up, but it's still a great advantage for people to do business with us, even if they have perfect credit and all that. If they meet the income guidelines, because our rate will be better.
Right.
Okay, that was it.
And as rates rise, we would expect that difference to widen
Yes.
as the difference between taxable and our to take advantage of our tax.
Absolutely.
Correct.
Yes.
So yes, I mean, yeah, the rates are high, and that's why you're not going to see the numbers that we will see when the rates are lower, because between inventory and the fact that some people, no matter what we do, are not going to be able to qualify because of the debt to income ratio, because the rate is so much higher. And even if our rate is lower, it's still going to be higher than what it was.
Correct.
Right. So if rates rise and the differential between our first time home buyer product and just regular commercially available loan product from banks, that gets to be pretty wide, we should finally see an end to our underperformance versus budget and historical performance on loan origination, all things being equal. My sense is we won't, because there's other stuff going on in the housing market that's also outside our control. But when we start seeing that, and if we're still having trouble originating loans, we're going to have to then revert back to, okay, what within our control, and maybe things that are not, because it's different by the home market, that we can basically, help support the housing market.
Right. Like, for instance, I had a conversation. I was in a function yesterday. Somebody asked me, why is CHFA's rate higher than the market? I said, that's not true. What you're looking at is a 15 rate. Without knowing any facts, I said, I bet you that the rate you're looking at is a 15 year. The rate that we're posting is 30 years. And I say, I haven't looked at it in a while, so I'm going to guess it's somewhere in the 5.25.
5.5.
But okay, like I said, I haven't looked at it in a while. I says, but I bet you if you look bank rate or anywhere else, the 30-year rate is over 6%. So I say, without doing any research, I'll bet you lunch that the CHFA rate is still going to be 1/4 to 1/2 point lower than any rate you're going to find out there.
The other thing,
Unless it's something
don't-
that is
sorry.
subsidized by your employer, right? Some employers have, like Yale has a subsidy,
The other thing that people don't realize is that Fannie Mae's, or the conventional products that we get for housing finance agencies doesn't have some of the loan level pricing adjustments that regular lenders have. So those products, even though the rate might be, so it has to be an apples to apples comparison because the rate might not be a full indication of the fees and expenses that are.
Right, and there's a big thing about an extra fee that they charge you now.
Yeah, well, it's just a period of rapidly increasing rates and obviously we're going to have some problems with affordability at some point, or we probably already are.
I would say we already do,
Yeah. Oh, yeah, yeah. Correct.
regardless if you have the income or not.
Oh, yeah, you're right. Even without the interest rates, affordability. But they say housing prices are going to adjust soon. For
Well,
all,
what's happening is instead of going up 25%, they're going up, 18, 20%, right?
yeah,
At least that's the numbers I'm seeing lately.
yeah. And just anecdotally in my own personal life, some people I know are having real struggles with rents. Landlords are selling their houses and the new landlord wants much higher rents. And some people are being actually put out on the street, pretty much. It's really rough out there for renters right now. But with all these sales.
That is true. That is true.
Any other questions or matters to discuss today? We'll go to the minutes for the Finance and Audit Committee. May I have a motion?
So move. This is George.
Second?
I'll second Jerry.
Okay, roll call vote.
Jerry Abrahams.
Aye.
Alexandra Dahm.
Approved.
Phil DeFronzo.
Approved.
Tim Hodges. Catherine McKinnon. Commissioner Perez.
Yes.
Franklin Perry.
Approved.
Sarah Sanders.
Yes.
Vote passes unanimously.
Okay, if there's no other matters, I'll ask for a verbal vote to adjourn the meeting. All in favor, say aye.
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 Okay. Thank you, everybody.
See you in a little bit.
Thank you.